Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darcy here to bring you the daily recap. So today, we've been talking about how the market had felt a little bit heavy despite the fact that, yes, we had been trading in an upper range, low volume, summer type trading, but there was a little bit of a heavy feel to some of the action over the last few days. And we've done a good job, I think, in our Off the Charts newsletter, in the VTF, everybody's been talking about positioning a little bit and preparing for some potential downside, as it felt like the risk-reward ratio in particular was skewed more in favor of putting on some short positions or at least being cautious rather than looking to chase stocks at new highs. You know, we go through every night and off the charts and we try to find the best setups, and we've really been having a tough time finding bullish setups. You know, we've been focusing largely on trying to highlight bullish patterns because the macro trend is to the upside. The shorter term trends are to the upside, so that has been our focus. But we've really been having a tough time finding really compelling patterns. And so that tells you right there that there's definitely the potential for a little bit of downside in the market, and you might not get a new blast off the highs. And that's what we saw today. A lot of the damage was done pre-market, and then we were weak in the morning after the gap down. We can take a look at the chart of the spiders to give you a visual. Also, just a note, if you're not signed up for the 4:30 webinar with Evan Lazarus and Rich Annunziata, I would do that. The link is on our homepage, so I'm going to try to be a little bit brief here so you guys can get into that webinar. But take a look at the chart of the spiders now. You saw that gap down from this morning, and then there was no coming back from that gap. It was a gap and go to the downside, which tells you that there is a little bit of commitment to the downside, which means it could last for a little while, this pullback, or we could get some rest after today's gap and go to the downside. But it tells you there wasn't a ton of interest in people buying this gap down. Yes, it is summer trading, low volume, all that type of stuff. But I think was the move that a lot of people I think were expecting. The question now is how far does it go? How deep is the correction? I personally don't think we're going to get a 1987 style Black Friday crash the way some people are fear mongering out there. I think it's irresponsible to even talk about that because I think it sort of becomes a little bit of a self-fulfilling prophecy when you have people jittery and scared based on people in the media putting out projections like that. But we'll measure each level as it goes. There's also a nice blog post that we put together in the afternoon that highlights the recent charts that we've been sending out via StockTwits and on off the charts, highlighting S&P levels in action. And it's not to pat ourselves on the back or to beat our chest. It's just to show you that there is a way to have a method and a system in place that you can use micro levels to position yourself if you are a short-term active trader for potential moves, counter-trend moves in this case, corrections, and what's been a really strong tape this year. From a stock-specific perspective, Apple continues to stand out. We can go ahead and take a look at the chart there. Continues to hold up really well. You had obviously Carl Icahn with that tweet, gave it a lot of juice on this day. And then you had Leon Cooperman of Omega jumping on board and saying he has a big stake in Apple as well. So you have two really big names coming in and psychologically providing a big boost to the stock and making Apple investors feel really secure. And I think that'll do a lot for sentiment in the stock going forward. It's at $500. I think it could continue higher from here. And based on the way it showed resilience today, that's more evidence that it could continue to the upside. In the short term, it's a little bit extended. At the very least, you would like to see some sideways action, some rest before more upside. But sometimes Apple doesn't wait for you. Apple's the type of stock that when it goes, it goes. It doesn't wait at the train station to let people on and stuff like that. It goes and doesn't let a lot of people in when it really makes a big move. So I wouldn't be surprised to not see it rest a ton. But if you want to be prudent and abide by a system, never chase. And right now, Apple a little bit short-term extended. Facebook, sort of an opposite story in the short term. Over the last week or so, it's turned a little bit weak. After that huge earnings gap and go, this has really changed character. So this is one that in the past you'd say, I don't trust Facebook. After a multiple day rally, Facebook would almost always fail. But now I think it's changed character to the point that you can trust it on dips a little bit more. And there's all kinds of stuff they're talking about. They're talking about a mobile payment system that they're going to rival PayPal with. They might come out with. They're talking about putting video ads into people's news feeds. They could potentially add, Morgan Stanley estimated it could add $6 billion of revenue by 2020. So they have different ways that they're monetizing their platform right now, and the usership continues to grow, and then they're doing a better job on mobile, as has been well publicized in that earnings report. So this is one that this 36 level was an interesting level. it was the low from this candlestick right here, and I think a natural level to test some dip buys. So I think this is one that could be compelling if the market does find its footing. I think Facebook could get back to highs, and I don't think the highs of the year are in on Facebook. I think it'll be in the $40 range or in the 40s at some point this year. I think people are really buying into the transformation they've undergone. The home builders were strong today. We'll just go straight to the chart of that. XHB, it was strong after the gap down, so impressive resilience to close back above the 200-day moving average. Maybe a sign that we're not going to accelerate more to the downside, that perhaps this downside could be contained a little bit when you have a sector like the XHB able to show this type of resilience to finish right near the flat line after a big gap down. So you look for clues in different sectors, and this tells you perhaps the market is going to just have a shallow correction again, despite the size of today's gap down, today's sell-off. Gold was actually surprisingly strong today. It's sort of twisted the way the market works these days, but one of the reasons people were talking about the market being down because we had some really strong economic data this morning. And normally you'd think, okay, strong economic data, the Fed is more likely to taper in September, so gold would go down because gold responds positively to QE and all that type of stuff. But instead, gold was really strong. So maybe there's more indications coming through. Maybe this data is not going to really influence the Fed's thinking, and there's some indications coming through that the Fed is not going to taper in September. You never know. Things leak out. It's just the nature of the business. But this reaction in gold would tell you that expectations for September tapering aren't what maybe a lot of people think they are. So it'd be very interesting to see the price action in gold. If it continues to the upside, there's got to be something that we're not aware of that's going on with some central bank buying into a big position in gold or something, or there's word leaking out that September Fed QE tapering is not going to happen. So it'll just be very interesting to watch, and sort of a counterintuitive move today in gold. You can take a look at the chart and see it. Silver was even stronger. So ever since that low that we came out with our morning note on June 27th, and the title was Silver Linings Playbook. It was basically a playbook for playing an oversold bounce in silver, and that's obviously worked out really well. Some choppy action in the short term, but obviously a nice acceleration here over the last week and a half. On the weak side, you have several high-profile tech names that are really weak. IBM is one that I talked about on Twitter, and I've talked about in a couple of videos I've done, one that I expect to see more downside because we're seeing a major long-term uptrend break. Go to the monthly chart, you can see it better. From late 2008, it's been a really strong uptrend ever since then. But then we're breaking below this floor right here, which is a really key inflection point, or could be for IBM, as it's sort of rolling over with a rounded top, some lower highs in place. This is one that I do think could see more downside after people are starting to grow, in the analyst community, starting to grow a little bit more cautious on it, and breaking below this floor here could be something that triggers more downside. Amazon also remains weak. It's one that on any significant dip, I'm a fan of Jeff Bezos and all that type of stuff, and I think Amazon, yes, they don't make money right now, but when they do start to turn a profit, they're going to really accelerate their earnings really quickly. Yeah, it's stuck in a downtrend. Levels to watch here. This has already been drawn for me, so it bounced off that 285 level sort of today. Could be an area that gives it a little bit of support. Obviously, a lot of it's going to depend on the market right now, so this is one that not a compelling setup in Amazon, but if you're looking to buy dips and you're a fan of the growth story with Amazon, could be an area to look for an oversold type bounce. We'll take a look at Google as well. Google was weak also, another one of those ones that was really in favor for most of the year, but has lost momentum recently as you've seen stocks like Apple and Facebook start to emerge. Some of these old hats that had, like I said, been leading the market for a lot of the year, weakening. Nothing really to make you excited about buying Google yet, but it's a company that long term I'd feel comfortable putting money to work in Google on any major dip. Another dip buy potential stock is Cree. Cree is an LED light bulb producer. They're actually based in my hometown of Durham, North Carolina. So another reason why it's on my radar specifically, but this was a rock star for most of the year. It was up around 150% for the year prior to this most recent earnings report. Really firm uptrend, and then the numbers came in much worse than expected. Wall Street souring on it a little bit, but I really do think if it can get down to this $50 area is the area that I'm sort of stalking. Right here you can see this candle. It's a nice little support pivot. If it can get down to that $50 area, this is one that I might look to put money to work in long term. That's more of my focus and with my personal forays into the market. And this is one that interests me not only because it's based in my hometown, but I think the company has a really compelling story. So if we do get a deeper correction, we see a little bit of a base form, maybe a rounding bottom, it's one that I might look to get involved with. But with these dip buy type plays, you never want to catch a falling knife, all that. You want to be extra patient, very cautious. You don't have to be involved with the trade, but if a great trade falls into your lap because something overreacts a little bit to an earnings report, then you pounce on it. But be patient, be cautious, and I think that's the best way to approach situations like this. Then just another couple things. We talked about that data this morning being stronger, and the narrative there would be that strong data will make the Fed more likely to cut the size of QE in September. So the sectors that will respond most to that and responded most to the initial mentions of potential QE tapering are the safety, dividend yield type sectors like utilities and consumer staples. So that'll be something to keep an eye on. You look at the XLU in particular, that's a dividend staple type sector, and it was really weak today. Perhaps evidence of that theory that the strong data makes the Fed more likely to cut the size of QE. So if we see continued weakness in this sector ETF, the XLU, utilities, could be evidence of that narrative being perpetuated a little bit. And it's also a sector that I expect to be a little bit weak because I think the Fed will taper, whether it's in September, December, whenever. I think this is a sector that could weaken, could retest the lows at some point. You see all the moving averages starting to curl down. XLP, same situation. Consumer staples and other dividend. You see how weak this was today. So perfect example of, price action is king, technicals, all that, but understanding a little bit of complexity about, what Fed QE tapering could mean for certain sectors. I think it's important to have a little bit of that complexity, a little bit of that awareness. And as you can see, consumer staples weak today. I think it will continue. The utilities and consumer staples, I think, could be laggard sectors in the market going forward for the rest of this year. This has been John Darcy here for your daily recap. If you're not already tuned in to the webinar with Laz and Rich, I would go over there. It's GoToWebinars where we're hosting it. So sign up, get in there if you're not already there. This has been John Darcy for your daily recap. We'll see you tomorrow.